Singapore's debt might seem alarming at first glance. When you hear that Singapore has one of the highest debt-to-GDP ratios in the world, it can be quite shocking. This small island nation, known for its economic prowess and stability, seems to be carrying a mountain of debt. But what does this really mean for Singapore and its economy? It has one of the highest debt-to-GDP ratios in the world. This statistic often places Singapore in the spotlight, drawing comparisons with other nations that are struggling under the weight of their debts. However, it's crucial to understand the context behind these numbers. This figure often makes headlines and raises eyebrows. Financial analysts and news outlets frequently discuss Singapore's debt levels, sometimes painting a picture of impending financial doom. But is this portrayal accurate? But here's the surprising truth. Singapore isn't afraid of its debt. Unlike many countries that view debt as a burden, Singapore sees it as a strategic tool. The government and financial institutions in Singapore have a different approach to managing and utilizing debt. In fact, it's quite comfortable with it. The confidence stems from a well-thought-out financial strategy that leverages debt for growth and development. This approach has allowed Singapore to maintain its status as a global financial hub. This is because Singapore uses debt differently than many other countries. Instead of borrowing to cover budget deficits or fund day-to-day expenses, Singapore's debt is primarily used for investments that yield long-term benefits. It doesn't borrow heavily to cover budget deficits or fund day-to-day expenses. This disciplined approach ensures that the debt is sustainable and manageable without putting undue pressure on the nation's finances. Instead, Singapore strategically uses debt as a tool for investment and long-term growth. By channeling borrowed funds into infrastructure projects, technological advancements, and other growth-oriented initiatives, Singapore ensures that its debt contributes to the nation's prosperity and future readiness. Imagine taking out a loan, not to buy a fancy car, but to invest in a promising business. That's essentially what Singapore does with its debt. It views borrowing as an opportunity to generate future returns. This approach is fundamental to understanding why Singapore's debt isn't a cause for concern. It's not about spending beyond its means. It's about strategically investing in its future. Singapore employs various financial instruments to manage its debt. These include Singapore Government Securities, Special Singapore Government Securities, and Singapore Savings Bonds. These are essentially loans that the government takes from individuals and institutions. However, unlike bonds issued by many other countries, the proceeds from these Singaporean securities are primarily used for investment purposes. They are channeled into a diverse portfolio of assets, both domestically and globally. Singapore's fiscal management is characterized by prudence and discipline. The government consistently generates strong revenue through effective tax collection. It levies taxes on income, corporate profits, goods, and services. This robust revenue stream, combined with its strategic use of debt, ensures that Singapore maintains a healthy balance sheet. Its assets consistently outweigh its liabilities, making it a net creditor to the world. A key element in Singapore's fiscal strategy is the Net Investment Returns Contribution, or NIRC. This framework plays a crucial role in funding government spending and ensuring long-term fiscal sustainability. The NIRC represents the returns generated from investments made by Singapore's sovereign wealth funds, GIC, and Temasek Holdings. These funds manage a significant portion of the country's reserves, investing them globally to achieve long-term growth. Building for the future. Singapore recognizes the importance of investing in infrastructure to support its continued growth and development. The city-state has always been forward-thinking, understanding that a robust infrastructure is the backbone of a thriving economy. From expanding its world-renowned Changi Airport to developing the massive Tuas Megaport, Singapore is laying the groundwork for a prosperous future. To finance these large-scale projects, it utilizes the Significant Infrastructure Loan Act, also known as SINGA. This legislative framework is crucial for ensuring that the necessary funds are available for these ambitious undertakings. The Act was designed to provide a sustainable financial model for infrastructure development, allowing the government to plan and execute projects without compromising fiscal stability. This act allows the government to borrow specifically for infrastructure development with a borrowing limit set at 90 billion Singapore dollars. This borrowing is carefully managed to ensure that it does not lead to excessive debt, maintaining a balance between development and financial prudence. The funds are allocated to projects that promise long-term benefits for the nation. This approach ensures that the cost of essential infrastructure is distributed across generations who will benefit from these investments. By spreading the financial burden over time, Singapore ensures that future generations inherit not just the debt, but also the benefits of a well-developed infrastructure. This forward-looking strategy is key to maintaining the nation's competitive edge and quality of life for its citizens. Beyond physical infrastructure, Singapore is also investing in education and technology to build a knowledge-based economy. These investments are crucial for fostering innovation and ensuring that the workforce is equipped with the skills needed for the future. By focusing on both tangible and intangible assets, Singapore is truly building for the future. A AAA report card. Singapore's prudent fiscal management and robust financial health have earned it the highest credit rating, AAA, from all three major credit rating agencies, Standard & Poor's, Moody's, and Fitch. This prestigious rating signifies that Singapore has a very strong capacity to meet its financial commitments. It is a testament to the country's effective debt management and overall economic stability. A different approach. Many countries with high debt levels borrow primarily to cover budget deficits. This can lead to a vicious cycle of increasing debt and interest payments, potentially hindering economic growth. Singapore's approach stands in stark contrast. By focusing on investment-driven borrowing, it ensures that its debt is used to generate future income and enhance its long-term economic prospects. A secure future. Singapore's debt, while significant in size, is managed strategically and responsibly. The government employs a meticulous approach to ensure that every dollar borrowed is put to productive use. This involves investing in infrastructure, education, and technology, which are key drivers of economic growth. By focusing on these areas, Singapore not only boosts its current economic performance, but also lays a strong foundation for future generations. The country's commitment to fiscal discipline, long-term investment, and robust institutions has created a virtuous cycle of economic growth and stability. This disciplined approach is evident in the way Singapore plans its budget, prioritizing essential sectors while maintaining a healthy reserve. The government's transparent policies and accountability measures further reinforce public trust and investor confidence. This approach ensures that Singapore's debt, rather than being a burden, becomes a catalyst for continued progress and prosperity. The strategic management of debt allows for continuous improvement in public services and infrastructure, making life better for its citizens. Moreover, it positions Singapore as a resilient economy capable of withstanding global financial uncertainties. It's a model that demonstrates how debt, when managed effectively, can be a powerful tool for building a secure and prosperous future. Singapore's experience offers valuable lessons for other nations grappling with debt management. By prioritizing strategic investments and maintaining fiscal discipline, countries can transform debt from a potential liability into a significant asset driving long-term growth and stability.